Hello everyone. Now in the booster series of lectures, let us start with the fourth chapter, Income from Salaries. What are the sections that are covered under the head Salaries? Section 15 to 17. Basically three sections. What is the charging section? Charging section is section 15. Method of accounting followed under this head is due or receipt basis, whichever is earlier. In our previous lecture in residential status, we have discussed the difference between accrual and due. Accrue means what? Right to receive. Due means what? Right to enforce the payment. Let's say employer and employee, they entered into agreement. Salary of employee will paid by employer on 7th of next month. This is the agreement. That means what? In the month of August, employee rendered his services. When his salary gets due, his salary gets due on 7th September. Salary is accrued in the month of August, but salary will get due in the month of September, 7th September. Are you able to understand? So, let's say an employee joined in the month of April and employer will pay salary to him on 7th of next month. Now, how many months salary will get taxed to him? April month salary will get due on 7th May. May month salary gets due on 7th June. Likewise, every month salary will get due on 7th of the next month. So considering this, like April month salary is getting due in the month of May month salary is getting due in the month of June. So overall 11 months salary is only taxable in current previous year. From next previous year onwards, 12 months salary is taxable. Are you able to understand? So due means what? Due date. On the due date, it gets taxed. Even though on the due date salary is not paid, still salary will get taxed because the method of accounting followed is due or receipt basis, whichever is earlier. Advance salary was received. Advance salary is taxable whenever it is received. Let's say this is the month of February. I am in need of money. I went to my employer and I asked him to pay March month salary also in the month of February. Employer paid February salary and March salary in the middle of February. Now, whatever the advance salary that I have received, it is taxable to me. Another example. Now, I am in urgent need of money. I want 4 months salary. March, April, May, June. April, May, June are falling in next financial year. Even though they are falling in next financial year, if those months salary is received in current previous year, it gets taxed in current previous year because like it will get due in the next year, but it is received in advance. Advance salary is taxable on receipt basis. Are you able to understand? So the method of accounting followed under the head salaries is due or receipt basis, whichever is earlier. Next, provision. What provision says? Let's say there is employer, there is also employee. Whatever the benefits received by employee from employer are there, these benefits can be either monetary benefits or non-monetary benefits. All these benefits are taxable to the employee under the head salaries. So many people think that only monetary benefits are taxable. No, not only monetary benefits, even if any non-monetary benefits are received by employee, those non-monetary benefits are also taxable to the employee under the head salaries. Now, employer can be either past employer or present employer or future employer. See, pension is taxable under the head salaries. After retirement, pension is received. Pension is received from past employer. Even though benefit is received from past employer, that is taxable under the head salaries. Next, anyhow, benefit received from present employer is taxable under the head salaries. Future employer, many of the CAs are getting qualified, they are going to campus and they are getting jobs. Now, after they get selected in campus, they will get 1 month time. Okay, company will do background verification, then company will give joining letter. So meanwhile, in these 15 days to 1 month, employee may go and join in another company. That's why once you are selected by a company, they will give you salary in advance even before you join the company, just to retain you. In such a case, whatever the advance salary that you have received from future employer, you did not join the company, but you have received advance salary from the employer whom you are going to join, okay, future employer, even that benefit is also taxable under the head salaries. And some of the students asks me, sir, only full-time employment? No, even by doing part-time employment, if any benefit is received, that benefit is taxable under the head salaries. Not only full-time employment, from part-time also. Next, main important point, precondition. Only if this condition exists, then only benefit is taxable under the head salary. What is that condition? Like, in between employer and employee, there should be principal and servant relation. Only if the relation between payer and payee, here we can call employer as payer and employee as payee. The relationship between employer and employee should be principal and servant relation. Then only the benefit received is taxable under the head salaries. See, there are two types of relations: principal to servant relation, principal to principal relation. In case of principal to principal relation, like, one party tells to another party what is the work that is to be done, how that work is required to be performed. It is entirely at the discretion of the opposite person. That kind of relation we call as principal to principal relation. Best example, the relation between doctor and patient. Okay, patient will come to the doctor and he will tell his problem to the doctor. How to treat that problem, how to cure that disease, treat that disease, that is entirely at the decision of the doctor. This type of relation we call as principal to principal relation. Okay, chartered accountant and client are there. Client will come to the chartered accountant and ask him to do the audit. How audit is to be performed, that is entirely at the decision of the chartered accountant. Lawyer and client are there. Now client will tell what is his problem and what exactly the facts are. Now lawyer will decide how to how to speak in the court of law. That means what, in all these relations, one person is telling another person what is the real problem and how to treat that problem is entirely at the decision of the opposite person. This type of relation we call as principal to principal relation. Out of principal to principal relation, if we get any benefit, if we receive any income, that income is taxable under the head PGBP. But out of principal to servant relation, in case of principal to servant relation, principal will tell servant what is the work that is to be done, how that work is required to be performed, how that work should be performed. That will also be told by the principal. If that work is not done properly, action can also be taken by principal. This type of relation we call as principal to servant relation. Employer will tell employee what is his scope of work and how that work is required to be performed. If work is not done properly, employer can take action. This type of relation we call as principal to servant relation. Out of principal to servant relation, if any benefit is received, that benefit is taxable under the head income from salaries. Are you able to understand? Good. So I have explained the precondition and general provision. See, in all these cases, whatever the benefit that is received, that is not taxable under the head salaries, but that is taxable under other heads. The only reason is there is no relationship of principal and servant. Only if there is relationship of principal and servant between payer and payee, then only benefit is taxable under the head salaries. Commission received by insurance agents. See, insurance agents, if they get commission from insurance companies, insurance agents, right? How many policies they do, that much of commission they will receive. That means what? Here the relation is a bit of principal to principal relation. So whatever the commission received by insurance agent is there, that is not taxable under salaries because there is no principal and servant relationship. That is taxable either under PGBP or under IFOS. Remuneration received by partner from partnership firm. See, uh, the relationship between a partner and partnership firm is not principal and servant relationship. That's why even though partner gets remuneration from partnership firm, such remuneration is not taxable to the partner under the head salaries. It is taxable under the head PGBP. Next, pension received by family members of deceased employee. Listen one thing. I worked in an organization. After I came out of that organization, I am receiving pension. That pension is taxable to me under the head salaries because I am receiving benefit from past employer. After my death, my family members are receiving pension. Now, in between that employer and me, there is employer employer relationship, company and me. But in between company and my family members, there is no employer employer relationship, right? That's why if my family members receive any pension from the company, for them the whatever the pension that is received, that is taxable under other sources, as there is no employer employer relationship between company and family members of the deceased employee. Next, directors sitting fees. If any fees is received by director other than under employer employee agreement, then that fees is taxable to the director under the head income from other sources. For example, whole time director is there. Whole time director is a full time employee of the company. So if any remuneration is received as a whole time director, that is taxable to the whole time director under the head income from salaries. But for attending board meetings, if any sitting fees is received, that is taxable under PGBP because that is out of scope of employer employee agreement. Similarly, company wants loan. Banker said banker will give loan only if director of the company gives guarantee. Now director of the company gives personal guarantee, based on that banker gave loan to the company. Now director is providing additional service apart from his employer employee agreement. He is like, other than employer employee agreement, director is also giving additional service in the form of giving personal guarantee. For that, company paid some fees to the director. That fees is taxable to the director under other sources because whatever the benefit that is received, that is out of scope of employer employee agreement. Salary of MP and MLA. See, MPs and MLAs, they are public representatives. They are not employees of government. That's why whatever the benefit that is received by MPs and MLAs from government is there, that remuneration is taxable under other sources. Yes, you can quite often see many lecturers who are teaching in college, like they will go for valuation of public exam papers, or they will set question papers for public exam. For doing such activities, if they receive any amount, that benefit is not taxable under salaries, that benefit is taxable under other sources. In a private college, lecturer is working. From private college, if any benefit is received, that is taxable under the head income from salaries because there is employer-employer relationship between private college and lecturer. But for valuing question papers, if any amount is received from government, there is no relationship of employer-employee between that government university and lecturer. That's why whatever the amount received for valuing question papers is there, that is taxable under other sources. So this we have discussed past, present or future employer. And another thing, at the same time, employee can have more than one employer and whatever the benefit that is received from all employers is there, that is taxable under the head salaries. Mr. Ramakrishna is there. Morning to afternoon, he works in Chaitanya College. Afternoon to evening, he works in Narayana College. So from Chaitanya College and Narayana College, he is receiving salary. So both the salaries are taxable to him under the head income from salaries. He is having two employers, Chaitanya College, Narayana College. Both the benefits are taxable to him under the head salaries. Next. Let us see the format in which income is computed under the head salaries. Broadly, whatever the benefits that are received by employee are there, they are classified into 5 types. If these 5 types we have discussed, then salary chapter is almost over. Okay, what are those 5 benefits? Basic payments, taxable value of retirement benefits, taxable value of perquisites, taxable value of welfare contributions, taxable value of allowances. All these 5 benefits together we call as gross salary. From gross salary, we will reduce deductions under section 16. How many deductions are there? 3 deductions are there. First one is standard deduction. Very important when doing problems of income from salaries. Many students forget to claim standard deduction. They will do entire problem, at the end they will forget to claim standard deduction. Please don't forget, claim standard deduction. Okay, under both the tax rates, default tax rates, optional tax rates, standard deduction is available. Are you able to understand? Next, section 16 to 16.3, entertainment allowance, profession tax. These benefits are available only under optional tax rates. Careful, standard deduction available under both tax rates. Entertainment allowance, profession tax. These two benefits are available only under optional tax rates. After we reduce standard deduction, entertainment allowance and profession tax, we arrive at net salary. Now let us start discussing one by one. First, I am going to start with basic payments. See, whatever the basic payments are there, these are fully taxable, no exemption, deduction, nothing. Okay, basic salary is fully taxable. Advance salary, I already told you, it is taxable in the year of receipt. Another important point, once a salary is taxed on receipt basis, again it is not taxable on due basis. Once a salary is taxed on due basis, again it is not taxable on receipt basis. Employer did not pay salary to me, but due date came. Because of due date, salary got taxed to me. In future, employer paid me salary. Again, second time it is not going to get taxed. Arrears of salary. You know arrears, right? If earlier year's salary is received in current previous year, we call that as arrears of salary. For central government employees and state government employees, there will be pay revision. Dearness allowance percentage will be increased with effective from retrospective date. So from earlier year onwards, increase in DA will be received in current previous year. So earlier years DA, because of increase in percentage received in current previous year, we call it as arrears of salary. That is also taxable under the head salaries, and it is fully taxable, no point of exemption or deduction. Bonus fees, these are also completely taxable. And whatever the commission that is received by employee, irrespective of whether commission is fixed commission or whether the commission is as a percentage of turnover, commission received by employee is also fully taxable. And whatever these basic payments are there, these are fully taxable both for government employees as well as for non-government employees. Next, let us start our discussion with regard to retirement benefits. In retirement benefits, first I am going to start with gratuity. See, whatever gratuity is there, it is the amount given by employer to employee in appreciation of the services provided by employee. Generally, we call gratuity as gracious payment. There is one act called Payment of Gratuity Act 1972. As per that act, mandatorily gratuity is required to be paid. Like some employers, even though no provisions of Gratuity Act are not applicable, still voluntarily they will pay gratuity in appreciation of the services given by employee. Now, listen carefully. Gratuity discussion, it's a bit lengthy, and at the end I am also going to discuss one problem with you with regard to gratuity, then you will get complete clarity. So if gratuity is received during the service, that means when employee is working during the course of employment, if gratuity is received, then gratuity is fully taxable irrespective of whether employee is government employee or non-government employee. If gratuity is received at the time of retirement or termination or death, what do you mean by this? After death of employee or after retirement of employee or after termination of employee, if gratuity is received. If the employee is government employee, sir, who is called as government employee? Here it was given. For the purpose of gratuity, see, whatever government employee definition is there, this definition is applicable only for gratuity. Central government employee, state government employee, local authority employees, members of civil service, you know, IAS, IPS, IFS, and defense service. So 5 category of persons. So if gratuity is received after retirement or death or termination by central government employee or state government employee or local authority employee or defense employee or member of civil service. For these 5 category of persons, after retirement, if they receive gratuity, such gratuity is fully exempt. Other employee means what? Other employee means private employee, other than those 5 category of employees. If gratuity after retirement is received by private employees, then two classifications are there. First, we have to check whether that private employee is covered under Payment of Gratuity Act or not. If private employee is covered under Payment of Gratuity Act, one type of exemption is available. If private employee is not covered under Payment of Gratuity Act, another type of exemption is available. Are you able to understand? Now, listen carefully. When I am explaining this, you will get 60 to 70% clarity, but once we do the problem, you will get complete clarity. Listen all through patiently. If private employee is covered under Payment of Gratuity Act 1972, then exemption will be allowed in 3 steps. Statutory limit 20 lakhs, or actual gratuity received, or 15 by 26 into last drawn salary into years of service. See, there are two concepts: years of service, completed years of service. Completed years of service. In case of completed years of service, if there are any extra months, we will ignore extra months. We will consider only completed years. In case of years of service, if there are extra months, if extra months are greater than 6 months, then we will round off to 1 year. I will tell one example. Employee worked for 20 years 7 months. 20 years 7 months means what? Part of the year is greater than 6 months, right? For years of service, we will consider it as 21 years. For completed years of service, we will consider only 20 years. Part of the year should be ignored when we are calculating completed years of service. So whatever 7 months are there, that those should be ignored. Another example, 20 years 4 months. See, part of the year is less than 6 months, right? So we do not do round off. For years of service, it will be 20 years. For completed years of service also, it is 20 years. My dear friends, please remember, here there is small mistake. It's not greater than or equal to, it's greater than 6 months. If part of the year is greater than 6 months, we will round it off to next year for years of service calculation. For completed years of service calculation, we will completely ignore months, and whatever the completed years are there, only those we will consider. Next. For calculation of exemption, if employee covered under Payment of Gratuity Act, then for that we consider last drawn salary. What do you mean by last drawn salary? Salary of the employee immediately preceding the month of retirement. Let's say employee retired in the month of August. We will consider July month salary as last drawn salary. And what is definition of salary? Definition of salary is basic plus any DA. Basic plus any DA means what? DA is classified into two types: DA forming part of retirement benefits plus DA not forming part of retirement benefits. Both should be considered. So basic plus any DA, we will consider it as last drawn salary. So government employee after retirement, fully exempt. Private employee, two classifications are there. If he is covered under Payment of Gratuity Act, exemption will be allowed in 3 steps. Statutory limit 20 lakhs, or actual gratuity received, or 15 by 26 into last drawn salary into years of service. Last drawn salary means salary immediately preceding the month of retirement. Salary definition for this purpose is basic plus any DA. DA forming part of retirement benefits, or DA not forming part of retirement benefits. Like first step and second step easy, third step is only critical, which you will understand once I explain the problem. Shall we see the problem? Yes. Mr. Ravi retired on 15th June 2024. When he retired 15th June 2024, after completion of 26 years 8 months. That means what? Here part of the year is greater than 6 months. So years of service 27 years. Completed years of service is only 26 years. and received gratuity of 15 lakh rupees. At the time of retirement, his salary was basic salary 15,000 per month, dearness allowance 10,000 per month, 60% of which is for retirement benefits. That means what? Here DA forming part of retirement benefits is only 60%, not forming part of retirement benefits is 40%. Commission is also given, bonus is also given. Now, compute his taxable gratuity, assuming he is a private sector employee covered under Payment of Gratuity Act. If employee is covered under Payment of Gratuity Act, then exemption will be calculated in how many steps? 3 steps. What is the amount of gratuity received? Gratuity received is 15 lakhs. Shall we calculate? Gratuity received 15 lakhs. From this, we need to calculate exemption. Less exemption. If employee is covered under Payment of Gratuity Act, then exemption will be calculated in how many steps? 3 steps. Step 1, statutory limit 20 lakhs. Step 2, actual gratuity received. How much is actual gratuity received? 15 lakhs. Step 3, 15 by 26 into last drawn salary into years of service. What is definition of salary if employee is covered under Payment of Gratuity Act? Basic plus any DA, correct? So how much is basic salary? Basic salary is 50,000. DA, see whether it is forming part or not forming part. Total DA we need to consider 50,000 plus 10,000, 60,000. So 15 by 26 into 60,000 into how many are years of service? 27 years, right? So 15 by 26 into 60,000 into 27 years. 9,34,615. Out of these three, whichever is lower means 9,34,615. How much is taxable gratuity? 5,65,385. That is taxable gratuity. Hope now you got clarity. So if employee is covered under Payment of Gratuity Act, exemption is calculated in 3 steps. Statutory limit 20 lakhs or actual gratuity received, or 15 by 26 into last drawn salary into years of service. If he is a government employee, at the time of retirement, whatever the gratuity received, 15 lakhs is fully exempt, correct? Now, if he is not covered under Payment of Gratuity Act, let us see provision, then we will come back. If employee is not covered under Payment of Gratuity Act, then also exemption will be calculated in 3 steps. First 2 steps are common, okay, like statutory limit 20 lakhs or actual gratuity received, or half 1 by 2 into last 10 months average salary preceding the month of retirement. Employee is retiring in the month of January. Ignore January. Take December month salary. From December month onwards, like we have to consider 10 months back. Okay, last 10 months average salary preceding the month of retirement into completed years of service. You know completed years, right? Whatever the part of the year is there, we have to ignore it. Half into last 10 months average salary into completed years of service. Salary for this purpose is basic plus DA forms part of retirement benefits plus commission as a percentage of turnover. Are you able to understand? So 1 by 2 into last 10 months average salary into completed years of service. Let us see the problem so you will get clarity. First, now employee not covered under Payment of Gratuity Act, right? Here also exemption will be calculated in 3 steps. How much is gratuity received? 15 lakhs. From this we need to calculate exemption. Step 1, statutory limit is 20 lakhs. Step 2, actual gratuity received how much? 15 lakhs. Step 3, 1 by 2 into last 10 months average salary into completed years of service. Here what is critical is calculation of last 10 months average salary. Shall we calculate? So what is definition of salary? Basic plus DA forming part of retirement benefits plus commission as a percentage of turnover. How much is basic salary? Basic salary is 50,000 per month. So 50,000 into 10 months. Next, DA. Only we have to take forming part of retirement benefits. DA forming part of retirement benefits is only 60%. 10,000 into 60% into 10 months. Commission as a percentage of turnover. How much is commission for 12 months? That means annual commission is 1 crore 20 lakhs. We do not require 12 months. We require only 10 months. So 120 lakhs into 1%, right? 120 lakhs into 1% into 10 by 12. So we have to add all these. How much? 50,000 into 10. It will be 5 lakhs. 10,000 into 60% into 10 months. How much? 60,000. 120 lakhs into 1% into 10 by 12. How much? 1 lakh. So in total it is 6,60,000. So 1 by 2 into last drawn salary, last 10 months average salary. So 6,60,000 divided by 10 months into how many completed years of service? 26 years, right? Yes. Completed years of service, 26 years. So 6,60,000 divided by 10 divided by 2 into 26. How much? 8,58,000. Out of these three, whichever is lower means 8,58,000 is the exemption. And how much is taxable gratuity? 6,42,000 is taxable gratuity. Whether answer is correct? One second. I think 6,42,000, correct. 6,42,000 is the taxable gratuity. Hope you understood now. There are some note points, let us see. So average salary means last 10 months salary preceding the month of retirement. This exemption is available only if relationship of employer and employee exists. Obviously, for a benefit to get taxed under the head salaries, there should be relationship of employer and employee. Out of that relation, if gratuity is given, then only exemption is available. Otherwise, exemption is not available. Insurance company, for doing more number of policies, insurance company gave gratuity to one of its agent. Relation between company and agent is not employer and employee. Now whatever the gratuity received by agent is there, that is fully taxable, and this exemption is not available. Exemption under section 1010 is not available. Where gratuity received by an employee from more than one employer in the same previous year or in two different previous years, aggregate exemption cannot exceed 20 lakhs. What do you mean by this? For one employee in his lifetime, maximum exemption he can claim for gratuity is 20 lakhs. That means what? First employer, he gave gratuity 3 lakhs. Total 3 lakhs exempt, for example. Total 3 lakhs was exempt. For second employer, when you are calculating statutory limit, generally how much is statutory limit? 20 lakhs. But already from first employer 3 lakhs exemption was claimed, right? So when you are calculating gratuity exemption for the second time, then you have to take statutory limit as only 7 lakhs. That means what? If earlier gratuity exemption was claimed, whatever the gratuity exemption that was already claimed is there, that should be reduced while calculating statutory limit for the second gratuity calculation. Are you able to understand? So very simple. In his lifetime, maximum gratuity exemption employee can claim is 20 lakhs. So if already exemption was claimed, that is to be reduced, and only balance is to be considered as statutory limit for second calculation of gratuity exemption. Where gratuity is received in any earlier years from former employer and again received from another employer in the later previous year, limit of 20 lakhs will be reduced by amount of gratuity exempt earlier. I already told you, right? Whatever the gratuity exemption that was already claimed is there, that should be reduced in calculation of gratuity exemption for the second time. Now, see, government employees, if they receive gratuity after retirement, fully exempt. After death of government employees, if their family members receive, even that gratuity is also fully exempt. Service I have already explained to you. One another point I have to explain. Sir, what is this 7 by 26? For regular employees, in third step, we will take 15 by 26. For seasonal employees, we will consider 7 by 26. Best example, ice cream business is there, mango business is there. Those are seasonal businesses. While calculating gratuity exemption for seasonal employees, in third step, in place of 15 by 26, we will consider 7 by 26. Now let us discuss pension. See, pension is classified into two types, uncommuted pension and commuted pension. Generally, after retirement, pension will be given. Uncommuted pension means it's a periodic pension, let's say monthly pension, quarterly pension. So, at regular intervals, pension is being received. The type of pension we call as uncommuted pension. Uncommuted pension is fully taxable irrespective of the employee. That means uncommuted pension, whether it is received by government employee or private employee, it is fully taxable. Now the whole discussion is about commuted pension. Sir, what do you mean by commuted pension? I will tell you. Listen carefully, this is important. Now, an employee is receiving 30,000 per month pension. Out of 30,000 per month pension, suddenly employee is in need of 8 lakh rupees. He wants to get one surgery done. He wants 8 lakh rupees. Employee went to his past employer and told, sir, I am ready to commute 70% of my pension. That means I am ready to give away my 70% of pension. So after he gives away 70%, how much is balance? Balance is 9,000. That means till this month he is receiving 30,000 monthly pension. From next month onwards, he will not get 30,000 per month pension. He will only get 9,000 per month pension because he gave up 70% pension. For giving up 70% pension, he asked for lump sum pension of 8 lakh rupees. Whatever this lump sum pension of 8 lakh rupees is there, this we call as commuted pension. Are you able to understand? That means for foregoing certain part of the monthly pension, in consideration if employee receives lump sum pension, that lump sum pension we call as commuted pension. Now, if this commuted pension is received by government employees, it is fully exempt under section 10 clause 10a sub clause 1. So commuted pension means nothing but lump sum pension. Why lump sum pension was received? For commutation of part of the monthly pension or for commutation of total monthly pension. If lump sum pension is received, that lump sum pension is fully exempt. If commuted pension is received by other employees means what? Non-government employees or private employees. Then if employee is not receiving gratuity, half of the pension will be allowed as exemption. If employee is receiving gratuity, then 1/3 of the pension is allowed as exemption. What do you mean by this? I will tell. Now, see here employee commuted 70%. In return he got 8 lakh rupees. So how much is commuted pension? Commuted pension is 8 lakh rupees. From this exemption is allowed. For example, let's say employee is receiving gratuity. If employee is receiving gratuity, how much exemption will be allowed? If employee is receiving gratuity, then 1/3 is allowed as exemption, right? Many people commit mistake here. See, what is being said, 1/3 of commuted value of full pension. First we need to calculate full pension. How to calculate full pension? How much is exempted? Exemption is 1/3 of full pension. Now how to calculate full pension? 8 lakhs is for how much commutation? 70%. If 100% is commuted, how much? 11,42,857. This is full pension. Out of full pension, 1/3 is allowed as exemption. 11,42,857 into 1/3. How much? 3,80,952 is allowed as exemption. How much is balance? 4,19,048. This is taxable commuted pension. Are you able to understand? So before calculating exemption, first calculate full pension. How to calculate full pension? See, formula is also given. Commuted value of full pension is equal to amount received on commutation into 100 by commutation percentage. Here how much is commutation percentage? 70%. So 8 lakh divided by 70% into 100%. Okay, or you can also write like this, 8 lakh into 100 divided by 70. This is the formula. Amount full pension is equal to amount received on commutation into 100 divided by 70%. This is the formula. Now did you understand how to calculate commuted pension? So monthly pension or quarterly pension or periodical pension that is received, that is fully taxable both for government employees and non-government employees. Commuted pension, if it is received by government employees, fully exempt. If it is received by other employees, then we have to check whether employee is receiving gratuity or not. If employee is receiving gratuity, then then 1/3 of the full value of pension is allowed as exemption. If employee is not receiving gratuity, half of the full pension is allowed as exemption. Let us solve one problem so that you will get better clarity. Mr. Sagar, who retired on 1st October 2024, is receiving 5,000 per month as pension. This type of pension we call as uncommuted pension because it is received monthly. Whatever the monthly pension is there, that we call as uncommuted pension. On 1st February 2025, he commuted 60% of his pension. That means he gave up 60% of his pension. For giving up 60% of his pension, he received lump sum pension of 3 lakhs. So this 3 lakhs we call as commuted pension. Another thing, you are required to compute his taxable pension assuming he is a government employee. See, first of all, when he is a government employee, for government employee commuted pension is fully exempt, right? Only uncommuted pension is taxable. Am I correct? Good. Now, let's say a year consists like this. 1st April 24 to 31st March 25. When he got retired on 1st October 2024. From 1st February, on 1st February he commuted 60%. That means what? 1st February 25. For 3 months, October, November, December, he received 5,000 per month pension. For February and March, 2 months, he commuted 60%, right? 5,000 minus 60%. How much? He received 2,000 per month. That means 5,000 per month into 3 months plus 2,000 per month into 2 months. How much? 5,000 into 3, 15,000. Hold on. 4 months. October to January, how many months? 4 months. So 5,000 into 4, 20,000 plus 4,000. Total 24,000. So uncommuted pension is 24,000, that is fully taxable. You can see government employee, commuted pension fully exempt. Uncommuted pension taxable is 24,000. Now, he is a private sector employee, received gratuity. So he is in receipt of gratuity. How much exemption is allowed? 1/3 is allowed as exemption. Shall we calculate? So, commuted pension. How much is commuted pension? Commuted pension is 3 lakhs less exemption. He is receiving gratuity, right? So how much exemption is allowed? 1/3 of full pension is allowed as exemption. How much is full pension? 3 lakh is received for commuting how much percentage? 60 percentage. If 100% is commuted, how much he would have received? 3 lakh divided by 60 into 100. He would have received 5 lakhs. So 5 lakhs is full pension. So 1/3 of 5 lakhs. 5 lakh into 1 by 3. How much? 1,66,667 is exemption. How much is balance? 1,33,333. Taxable value of commuted pension. So commuted pension is 1,33,333. Uncommuted pension is taxable for all, right? For government employee it is taxable. Even for private employee also it is taxable. So 1,33,333 plus 24,000. How much? 1,57,333 is taxable pension. Let us see. Hold on. Yeah, 1,57,333. 1,57,333. If he is not receiving gratuity, then in place of 1 by 3, we will consider only half. So this is homework, you try. Very simple. Let me summarize quickly. Pension, if it is uncommuted, fully taxable. Commuted, received by government employee, fully exempt. Very important here, government employee means central government employee, state government employee, local authority, even statutory corporation, road transportation corporation, it is a statutory corporation. Even those employees receive any commuted pension, fully exempt. Okay, and like defense service employees and civil service employees. Now, if commuted pension is received by private employees, we have to check if they are receiving gratuity or not receiving gratuity. Receiving gratuity, 1/3 is allowed as exemption. 1/3 of full pension. Many people commit mistake. Whatever the commuted pension is there, on that they will apply 1 by 3. No, you should not apply like that. You have to calculate full pension. On full pension, you have to apply 1 by 3 or 1 by 2. Private employee not receiving gratuity, then half is allowed as exemption. Sir, why half? Why 1 by 3? Tell me one thing, which is greater, 1 by 3 or 1 by 2? 1 by 2 is greater, right? 1 by 2 is 0.5, 1 by 3 is 0.33. See, employee receiving gratuity, he will claim gratuity exemption, right? As he is already claiming gratuity exemption, lower pension exemption is allowed. Okay, that's why 1 by 3 exemption is allowed. If employee is not receiving gratuity, then he is not claiming gratuity exemption. As he is not claiming gratuity exemption, higher pension exemption 1 by 2 is allowed. This is the logic. In examination, you forgot, you are confused. 1 by 3 or 1 by 2. Check. Employee already receiving gratuity. As he is already receiving gratuity, lower pension exemption 1 by 3. Employee not receiving gratuity. As he is not receiving gratuity, higher pension exemption 1 by 2 is allowed. So even High Court judges and Supreme Court judges also can claim exemption for commuted pension. Now, if pension is received by family members after the death of the employee, then it is taxable under other sources. I have already discussed, as there is no employer-employee relation. Now let us discuss with leave encashment. When I used to work in Infosys, per quarter there are 4 leaves to me. That means in an year, 4 quarters into 4 leaves, 16 leaves are there to me. These are paid leaves. That means if I keep 16 leaves, no salary will be cut to me. But I used to utilize total 16 leaves. Additionally, I use it to keep extra leaves also. For that, I like salary will be reduced to me. But there are some senior employees in Infosys only, managers. If 16 leaves are there to them, hardly they will keep 5 to 6 leaves. Remaining 10 to 11 leaves were unutilized. They used to tell, if we go home anyhow, there will be headache. It's better to be there in office than in home. They find office as more happy than home. So they used to keep less leaves. So 10 to 11 unutilized leaves are there. For these unutilized leaves, at the end of the year, additional salary will be given. So whatever the additional salary that is given for unutilized leaves is there, that we call as leave encashment. So leave encashment encashed during the service. So during the course of employment only, if leave encashment is received, then such leave encashment is fully taxable both for government employees as well as for other employees. So during the course of employment, leave encashment received fully taxable both for government employees as well as for other employees. Leave encashment after retirement or termination or death. That means if leave encashment is received after death or termination or retirement, then if it is received by government employee, fully exempt. If it is received by other employees means what? Private employees or non-government employees. Then exemption will be calculated in 4 steps. Step 1, like actual leave encashment received. Step 2, statutory limit. So statutory limit for exemption for leave encashment is 25 lakhs. Step 3, 10 into last 10 months average salary. Last 10 months average salary preceding the date of retirement. Let's say today, February 6th, employee retired. From February 5th onwards, you have to take last 10 months. Last 10 months average salary preceding the date of retirement. Step 4 is cash value of unutilized leaves at the time of retirement. Cash value of unutilized leaves at the time of retirement. So first step is easy, second step is also easy, third step and fourth step are a little bit critical. Salary for this purpose is basic plus DA forms part of retirement benefits plus commission as a percentage of turnover. Here we will take only completed years. Completed years means what? If there is any part of the year, we will ignore part of the year. We will only consider completed years. The cash value of unutilized leaves at the time of retirement. So how to calculate this? That is the task. There are some steps. Listen to me. Now we have to consider maximum leaves allowed as per the organization. In Infosys, maximum leaves, for example, allowed in a year are 24 leaves. So we have to consider 24 days. As per Income Tax Act, maximum leaves allowed are 30 days. Out of these two, we need to consider whichever is lower. That means 24 days. See, in some organization, 40 days leaves will be given. But in this calculation, you should not consider 40 days. 40 or 30, whichever is lower means you will consider only 30 here. Are you able to understand? Good. So in Infosys, 24 days leaves are allowed. So 24 days or 30 days, whichever is lower, we have considered 24 days. This should be multiplied with completed years. Let's say I worked for 30 years. 24 days into 30 years. How many days? 720 days. So total 720 days leaves are available to me. Out of these, I have utilized. Utilized means what? I kept a leave. I kept a leave for 480 days. So I will arrive at unutilized leaves. How many are unutilized leaves? Unutilized leaves are 240 days. See here, unutilized leaves are in terms of days, right? We need to convert to months. Unutilized leaves in terms of months. Let's say I am considering average 30 days. 240 days divided by 30 days. How much? 8 months. Let's say last 10 months average salary. For example, last 10 months average salary is 40,000. Now 40,000 into 8 months. How much? 3,20,000. This is cash value of unutilized leaves at the time of retirement. Now did you understand how to calculate cash value of unutilized leaves? First you have to take leaves as per organization policy or maximum 30 days as per income tax act, whichever is lower. So you will arrive at number of leaves per year. That should be multiplied with completed years. So you will arrive at total leaves allowed as per the employment. During employment period, total leaves you will arrive. From that you have to reduce utilized leaves. Thereby you will arrive at unutilized leaves. From unutilized leaves, you have to convert in terms of months. So those unutilized leaves in terms of months should be multiplied with last 10 months average salary to arrive at cash value of unutilized leaves. That is step 4. Hope you got clarity. Let us do one problem so that you will understand better. So last 10 months average salary into 10. Average salary means salary for last 10 months preceding the date of retirement. Salary definition is basic plus DA forms part of retirement benefits plus commission as a percentage of turnover. See here. Gupta retired on 1st December 2024. When he got retired? 1st December 2024. After 20 years of service and received leave salary of 5 lakhs. So how much is leave encashment? 5 lakhs. Other details of his salary income are as follows. Basic salary 5,000 per month. 1,000 was increased with effect from 1st April 2024. What do you mean by this? Here consists of like this, right? From 1st April 2024. When he got retired on 1st December. So preceding day, what is preceding day? Preceding day is 30th November, right? So from 30th November last 10 months means from 1st February 24 up to 30th November. Okay. 1st February 24 to 30th November. February, March, April, May, June, July, August, September, October, November. Exactly 10 months. So from 1st April onwards, his salary increased by 1,000. How much is salary now? 5,000 rupees per month. That means before 1st April, his salary is only 4,000 per month, right? That's what? 4,000 plus 1,000. His salary was 5,000 rupees per month with effect from 1st April 24. Are you able to understand? See, now salary is 5,000, but what he said, from 1st April onwards 1,000 was increased. Due to increase of 1,000, now salary is 5,000. That means before 1st April his salary was 4,000. So last 10 months average basic salary is equal to 4,000 into 2 months plus 5,000 into 8 months divided by 10 months. How much is last 10 months average basic salary? 4,000 into 2, 5,000 into 8 divided by 10, 4,800. What is definition of salary? Salary for this purpose is equal to basic salary plus DA forms part of retirement benefits plus commission as a percentage of turnover. So last 10 months average salary is 4,800, correct? Now DA forming part of retirement benefits. How much is forming part of retirement benefits? 60%. That means what? 3,000 into 60% into 10 months divided by 10 months. There will be no change. Plus commission as a percentage of turnover. See, this is general commission 500 per month. What we need to consider? We need to consider commission as a percentage of turnover, that is 0. So 3,000 into 60% into 10 by 10, how much? 1800. 4,800 plus 1800, how much? 6,600. This is last 10 months average salary, correct? Now how much is leave encashment received? Leave encashment received is equal to how much? 5 lakhs, right? Is he a government employee? If he is government employee, it is fully exempt. If he is non-government employee, exemption will be allowed in 4 steps. Then exemption. Step 1, maximum exemption allowed is equal to statutory limit 25 lakhs. Step 2, actual leave encashment received how much? 5 lakhs. Step 3, 10 into 10 months average salary. How much is 10 months average salary? 6,600, 66,000. Step 4, we need to calculate cash value of unutilized leaves. How to calculate? In this question, he gave leaves availed during the year are 480 days. How many days he is eligible to? How many days he was given? 480 days leaves he was given, and as per organization 30 days leaves are allowed. Fine. See, up to 30 days, okay. If more than 30 days are given, as per Income Tax Act, they are restricted to only 30 days. So shall we calculate cash value of unutilized leaves? 30 days as per organization policy. As per income tax also 30 days, right? Whichever is lower means 30 days. How many completed years? He completed 20 years, right? 20 days. Sorry, 20 years. So leaves allowed. How many leaves are allowed? 20 into 30, 600 leaves are allowed. From this we will reduce utilized leaves. How many leaves he availed? Utilized leaves 480. That means how many unutilized leaves are there? Unutilized leaves 120. Okay, this is in terms of days. We need to convert in terms of months. 120 taking average 30 days in a month. How many months? 4 months. Now 10 months average salary. How much is 10 months average salary? 6,600. How much is cash value of unutilized leaves? 6,600 into 4 months. 26,400. This is cash value of unutilized leaves. So 26,400. Out of these 4, whichever is lower means 26,400. I think this is 5 lakhs, right? So from 5 lakhs, if you reduce 26,400, how much is taxable leave encashment? 473,600. That is the answer, right? 473,600. So did you understand how to calculate exemption for leave encashment? Another thing, maximum exemption allowed for leave encashment for an employee in his lifetime is 25 lakhs. That means in earlier years, if he has claimed leave encashment exemption, in current previous year, statutory limit is not 25 lakhs. In current previous year, statutory limit is 25 lakhs minus exemption already claimed earlier. Are you able to understand? Good. So even though in case of voluntary retirement, if any leave encashment is received, from that leave encashment exemption is allowed. Now let us discuss retrenchment compensation. See, there are many labor laws which will protect the rights of the employees. So if any employee is removed from the organization with immediate effect, or if there is any dispute, there are certain laws. Let's say Industrial Disputes Act 1947. It prescribes certain compensation. So if any compensation is paid as per the requirement of any labor laws applicable in India, such compensation we call as retrenchment compensation. So whatever the retrenchment compensation that is received, it is not fully taxable. Even from retrenchment compensation also you can claim exemption. That exemption will be allowed in 3 steps. Statutory limit 5 lakhs, or actual retrenchment compensation received, or 15 by 26 into average salary of last 3 months. So what is definition of salary? Basic plus any DA. Any DA means DA forming part of retirement benefits plus DA not forming part of retirement benefits. Last 3 months average salary preceding the date of retirement. So whatever the date of retirement is there, from that date you have to consider the preceding date. From preceding date you have to calculate 3 months. So shall we see one example so that you will understand better? So retrenchment compensation received, exemption allowed in 3 steps. Statutory limit 5 lakhs, actual retrenchment compensation received, or 15 by 26 into last 3 months average salary into into years of service. Now, Mr. Garg received retrenchment compensation. How much retrenchment compensation he received? 30 lakhs. After 30 years, for 4 months of service. So what is important for retrenchment compensation? For retrenchment compensation, important is years of service. Part of the month, part of the year is less than 6 months. So we do not do rounding off. Years of service will be 30 years. At the time of retrenchment, he was drawing basic salary of 20,000 per month and dearness allowance 5,000 per month. What is definition of salary? Basic plus any DA. So here we do not know whether it is forming part or not forming part. Still we have to consider DA because it includes any DA. Okay. So now let us see retrenchment compensation received. How much is received? 10 lakhs, right? From this we need to claim exemption. That exemption will be allowed in how many steps? That exemption will be allowed in 3 steps. Step 1, statutory limit. How much is statutory limit? 5 lakhs. Step 2, actual retrenchment compensation received. How much is actual retrenchment compensation received? 10 lakhs. Step 3, 15 by 26 into last 3 months average salary into years of service. Correct? 15 by 26 into what is definition of salary? Basic plus any DA, right? How much is basic salary? 20,000. DA is 5,000. So 20,000 into 3 plus 5,000 into 3 divided by 3. There is no change, right? Into 30. So 15 by 26 into 25,000 into 30 years. How much? 4,32,692. That is exemption. How much is taxable retrenchment compensation? 5,67,308. that is taxable retrenchment compensation. You can see. So now did you understand how to calculate retrenchment compensation exemption? See, read this point. Above limits will not be applicable to cases where compensation is paid under any scheme approved by central government for giving special protection to workmen under certain circumstances. So if any compensation is paid as per the you know scheme approved by central government, then whatever the compensation that is paid, it is fully exempt in the hands of employees. Now let us see VRS compensation. You quite often know organizations sometimes come up with the offer voluntary retirement scheme. If organization or company is having more number of employees, and if company wants to reduce its number of employees, then it will come up with the scheme voluntary retirement scheme. It is applicable for all employees. Now, whenever voluntary employment, I mean retirement scheme is announced, and you know employee opts for voluntary retirement scheme, company will give him voluntary retirement scheme compensation, and once employee receives VRS compensation, he should leave the organization. Again in his lifetime he should not again join the organization. So VRS is lump sum payment received. It can be received fully or it can be received in installments, and that can be received at the time of retirement or termination. Please remember, generally we call it as voluntary retirement scheme, and compensation received as voluntary retirement scheme compensation, VRS compensation. But if any public sector company, we do not call that scheme as VRS scheme, we call that scheme as voluntary separation scheme. So whenever you hear voluntary separation scheme, it is belonging to public sector company. For other category of companies and persons, we call that scheme as voluntary separation, voluntary retirement scheme or VRS compensation. So if any VRS compensation is received, it is not taxable 100%. From that also exemption is allowed. That exemption will be calculated in 3 steps. Statutory limit 5 lakhs, or actual VRS compensation received, or completed years into last drawn salary, or remaining months of service into last drawn salary. In third step, whichever is higher we will take. Are you able to understand? In 3 steps, whichever is lower we need to consider. That means what? Step 1, step 2, okay. In step 3 there are 2 sub steps, right? Out of these 2 sub steps, whichever is higher we will consider, and out of 3 steps, whichever is lower we have to consider. And salary for this purpose is basic plus DA forming part of retirement benefits plus commission as a percentage of turnover. Completed years of service. Completed years of service. If there is any part of the year, we will ignore part of the year. We do not round it off. Now, shall we see one problem for better understanding? Mr. Datta received voluntary retirement compensation of 7 lakhs after 30 years 4 months of service. That means what? Here what we consider? Here we consider only completed years of service. So how much are completed years of service? 30 years. He still has 6 years of service left. That means balance how many months? 6 years into 12 months. 72 months service is left. Correct? At the time of voluntary retirement, he was drawing basic salary 20,000 per month, DA which forms part of pay 5,000 per month. So basic salary 20,000, DA forming part is 5,000. Commission is not given. Compute his taxable voluntary retirement compensation. How much is voluntary retirement compensation received? 7 lakh rupees. Correct? VRS compensation received. How much is VRS compensation received? 7 lakhs. From this, exemption is allowed in how many steps? Exemption is allowed in 3 steps. Correct? Step 1, statutory limit 5 lakhs. Correct? Step 2, actual VRS compensation received. How much? 7 lakhs. In step 3, there are 2 sub steps, right? A, last drawn salary into 3 months into completed years of service. What is definition of salary? Basic plus any DA. So basic salary 20,000, DA is 5,000. 25,000 into 3 months into how many are completed years of service? 30 years, right? So 25,000 into 3 into 30 years. How much? 22.5 lakh. Or what is step B? Remaining months of service into last drawn salary. How many remaining months are there? Remaining months are 72 months, right? Correct. So 72 months into last drawn salary, how much? 25,000. 18 lakhs. Out of these two, whichever is higher, we need to take. How much is higher? 22.5 lakhs. Out of three steps, whichever is lower means 5 lakhs is allowed as exemption and balance 2 lakhs is taxable VRS compensation. So did you understand? 2 lakhs is taxable VRS compensation. Now, all employees are not eligible for exemption when VRS compensation is received. Only those employees, eligible employees, those employees who are working in these organizations, if they receive VRS compensation, then only they are eligible for VRS compensation exemption. So, employee should be either employee of a public sector company or any other company. That means company employees, if they receive VRS compensation, they are eligible for exemption. And an authority established under central, state or provincial act. That means as per any central government act or state act, if any authority is established, those employees who are working in that authority, Food Corporation of India, okay, so like it is established by state act, okay, so those employees who are working in that organization, okay, they are also eligible for VRS compensation exemption. Local authority employees, cooperative society employees, university or Indian Institute of Technology or such institute of management as central government may notify. So if central government notifies any institution or any company or organization, even that company or organization employees are also eligible for VRS exemption. Central government or state government or any institution notified by central government. So central government employees, state government employees or any institution notified by central government, okay, that institution employees, if they receive VRS compensation, they are eligible for exemption. So this exemption is available even though VRS compensation is received in installments. There is one rule called Rule 2BA. This Rule 2BA is applicable only for VRS compensation. For voluntary separation scheme given by public sector company, this Rule 2BA is not applicable. So whatever the Rule 2BA that we are going to discuss right now, it is applicable only when VRS compensation is received. If voluntary separation scheme compensation is received, then Rule 2BA is not applicable. So it prescribes that exemption under this section would be available to an employee who has completed 10 years of service or completed 40 years of age. So there are two conditions. What are they? First condition, employee should have completed 10 years of service. Condition 2, or completed 40 years of age. What is the conjunction? Conjunction is or. Out of these two conditions, if any one of the condition is satisfied. In 2004, employee joined in BSNL. At that time, his age is uh, 27 years. In 2011, he took VRS compensation. So in 2011, how much will be his age? His age will be 31. Now condition 1, did he finish 10 years? He did not finish 10 years. Condition 2, whether his age is 40 years, his age is also not 40 years. Now whenever he comes out of the organization by taking VRS compensation, for that VRS compensation he cannot claim exemption. Why he cannot claim exemption? Because he did not complete 10 years of service, or he also did not he also did not complete 40 years of age. Out of these two conditions, if any one of the condition is satisfied, then only exemption for VRS compensation is available. Another example, in 2008, an employee joined in the BSNL organization. At that time, his age is 33 years. In 2016, he retired from the BSNL by taking VRS compensation. Now in 2016, how much will be his age? His age will be 41 years. Did he finish 10 years of service? He did not, like 10 years was not completed, right? He did not finish 10 years of service, but his age is 41 years, greater than 40 years. Now if he receives any VRS compensation from BSNL, from that VRS compensation he can claim exemption. So to claim exemption, either he should have finished 10 years of service or he should have completed 40 years of age. Out of these two conditions, if any one of the condition is satisfied, then only he can claim exemption for VRS compensation. These conditions are applicable only if compensation is received for voluntary retirement scheme. If compensation is received for voluntary separation scheme under public sector company, then these conditions are not at all applicable. That means what? Under voluntary separation scheme, if any compensation is received, he is eligible to claim exemption irrespective of these conditions.